welcome to TheoTrade. This is Don Kaufman. It's August 24th, 2019, and you are watching the TheoTrade Weekend Update. In this weekend's update, we're going to get right to work. We're going to look at a few charts, okay? What is to come in terms of volatility. And again, we have a lot of very specific nuances that we're going to run you through. Let's get down to it. Markets on the verge of getting ugly out here. Listen, I want to start this weekend's update looking at the S&P 500. Now, again, I know not everybody necessarily trades futures contracts, but you got to understand, people, this is what drives order flow. And I'm going to zoom in for just a moment, pretty much to some of the current times over here. You know, earlier last week, I talked about this right here. What is this? This is actually what we termed like a volatility box. Now, the volatility box runs anywhere from about 29.40, okay, somewhere to the downside over here, which is about 28.30. And what we've actually seen inside of this volatility box is ever increasing, and again, ever increasing historical volatility. That is actual price movement in the marketplace is totally nuts in here. And you got to understand what you are really seeing here is we are getting wound up like a top on ever increasing and volatile moves inside of a very tight channel. Now, at this point in time, our gravity points, they've held true. All right, we had the 29.11. I mean, effectively 29.11 is where we started out on Friday afternoon. That was August 23rd. We came ripping down, okay, to 28.42, even crossed through it for a brief and fleeting moment. But again, these gravity points are holding, okay, relatively effective. Now, this idea of the volatility box that I brought up, basically, what does it really come down to? And again, I'll kind of zoom in on it for a second. You know, if you would ask me earlier this past trading week, it looked like we were going to crack the upside of the volatility box. Effectively, what I'm saying is push aside anything you know about options right now, anything you know about technicals, okay? You're in a really tight range, and you're seeing wild kind of intraday moves inside of an extraordinarily tight range. Okay, so the risk is just getting literally wound up like a top. Now, again, earlier this week, it looked like we were actually going to crack the outside of the upside, if you will, of the volatility box. And, you know, oh, there we go. We're still a stone's throw off the all-time high, right? Okay, here we go. It was a Twitter happy, a tweetastic, if you will, Friday morning, Friday afternoon. We're at the bottom of the volatility box right now. And things have gotten, well, effectively serious. You know, you had 6.5 hours of trade where pretty much everything effectively changed. Now we're actually threatening to crack the bottom edge of this volatility box. Now, listen, this is one that we've seen before. When I talk about the volatility box, for those of you that have been around for a while, allow me just to zoom in back to the, well, exact same thing that occurred. Here we go in October and November. And this one is also quite serious. We're actually literally pinging back and forth, okay, from gravity point to gravity point. We dropped into the volatility box in early October. We stayed in a very narrow range before things just got downright hideous, which actually brings me to the theme, of course, of this weekend's update. And are we on the verge of ugly over here? Again, this volatility box that we're currently in is substantially, if you will, more violent than what we saw even back in the October timeframe, given the fact the speed, if you will, of some of these moves from gravity point to gravity point. So with that, all right, we're going to push that aside for a second. I think everybody understands the implications, if you will, of you're inside of a very tight range. You're getting very substantial moves. We start to crack outside that range, and we are going to be off to the races. Okay, point made. Hopefully everybody's got that one behind them. Know your gravity points because these are going to be risk markers along the way. The 28.11, 27.31, 26.82. Okay, because right now, yeah, it does look like, again, the verge of ugly. Now, let's get to some really specific points. And we'll talk about, you know, a little bit about stocks and the overall marketplace, but we got to hammer through these points. Rate cut probability and the Fed. You know, I've seen some crazy things in my time But one of the things that really, really resonates with me right now is, well, let's bring it up. Okay, if you've never seen this before, compliments of the Chicago Mercantile Exchange Group, the CME Group. This is the Fed funds probability. All right, let me explain it briefly for those of you that have never really looked at it. Here we have the next Fed meeting. Right? There's a Fed meeting coming up. When is it? It's going to be September 18th. Yay! Okay, the Fed fund futures right here and right here. What are they effectively saying? Okay, here I actually have this set for probability mode. It's giving you, if you will, the probability, okay, of a Fed cut at the next meeting. What's the probability of the Fed cut? 95%. Can you believe that? 95%. By the way, there's even a 5% probability that people think they're going to cut by 50 basis points, right? Here, there's a 95% chance that people believe that we're going to cut by 25. Now I say 95% chance that people believe. Let me be very clear with Fed fund futures. This is a traded market. These are the Fed fund futures themselves. Okay. Now this, I don't want to geek out on everybody, but this, I mean, basically when you trade this product, when you trade Fed fund futures, okay, the Fed fund futures can be converted into specifically probabilities, which is exactly what you're seeing over here. So what do we learn about this? Excuse me, there's a 95% chance that the Fed is going to cut. Does the Fed say that? No, the Fed didn't say that. Okay. I just listened to the Jackson Hole speech from Jerome Powell like everybody else did. I've seen all the comments, read the comments, if you will, from all the Fed speak that went on this past week. No one is talking about, okay, a September rate cut coming. I mean, they might leave the door open, but right now the Fed is still pretty much steadfast in the idea of the last rate cut from just a couple of weeks ago was a mid-cycle adjustment. There's a big problem with that. So the rate cut probability in the Fed is 95%. The next Fed meeting, okay? Let's throw a tantrum in the meantime. What does that even mean? What's let's throw a tantrum, okay? This marketplace is going to dictate to the Fed exactly what they want. Whether you like it or not, they're going to dictate to the Fed exactly what they want. They're actually going to throw the marketplace very likely into turmoil, okay, to get what it wants. Oh, the market's very good at doing that. You know, you can't twist the hand of the Fed. No, you can break it. And the only way to break it at this point, and by the way, this very much an opinion piece. If you want to break the hand of the Fed and force the cut, you got to move these S&Ps. Okay, we've already moved the bond market. I mean, come on. The bonds are in never, never land over here. Take a look at the TYX, which is the 30-year. Okay, you have to look at this to just appreciate for a second. The 30-year is at 2%. What you have to recognize is effectively right now below even like, 1 month, like, notes and T-bills and so forth. I mean, this is a 30-year. The yield curve is completely and totally inverted in here. So when you take a look at this, the next Fed meeting, they're going to throw a tantrum. The marketplace is very, very likely to throw a tantrum in the near term to kind of, again, snap the arm of the Fed and force the rate cut. Because do you see any other reasonable means? Okay, I mean, China trade war. Well, we'll talk about that here in just a minute. So onward and upward. That again doesn't bode well for the future of the marketplace, given the fact that the logic that the Fed has given us is that they're not going to cut. The marketplace says there's a 95% chance. Okay, pretty sure that situation is coming to a head and in the very near term. All right, the next one I want to show you. Financials, they're under the risk marker. Let's actually jump from the S&Ps specifically over to the financials. Okay, I've mentioned this time and time again. The risk marker, I kind of lovingly call it the Maginot Line. 2650 inside of the financials, things get downright ugly. Look back at any of the recent trade in this marketplace. I'm going to reiterate this time and again in the next couple of weeks, but look back at any of this recent trade that we've seen, okay, specifically to the XLF. The XLF, okay, is warning you. By the way, I want to throw this out here. The XLF, okay, coming into that, remember the October volatility box I was talking about? Okay, that's what the financials looked like coming into, again, October. The financials were on the forefront of the sell side activity. Yeah, look right now. quite similar, okay? It's because the financials, they're on the forefront of the sell side activity. The marketplace does not progress to the upside unless the financials are with it. They are huge. They are an absolute staple in terms of a sector inside of the S&P 500. They are now under the risk marker of 2650 and then some. By the way, a little bit alarming on this front too. They have almost an 85 cent expected move on a 30% implied volatility. Why is that crazy? Now, I'm going to talk a little bit about expected move in the SPX as we move forward. But the S&Ps, they're sitting at like a 22 vol 6 days out. Okay, the financials are absolutely a rocking right now. 85-cent expected move. Now, onward and upward over there, the financials are under the risk marker, which the point that I really want to just drive home. Okay, in every recent bout of volatility in the S&P 500, okay, the financials, when things started to get serious, the financials were under 2650. Well, they're under 2650 right now. Okay, point made. Next, okay, this little bit of an opinion piece. Label me a currency manipulator? I'll show you a currency manipulator. Got to be really careful moving forward. So China comes out, of course. They retaliate on Friday morning, sends the S&P futures into a little bit of tailspin. Quite frankly, I think the S&P futures handled the China retaliation quite well because they were kind of expecting it. What they were not expecting is the Twitter flurry that followed thereafter. So there's a lot of, again, opinion piece in this, and here it is. They've called him a currency manipulator. Well, now it's time to actually put that currency manipulation into effect, and I would be extraordinarily careful. Overnight trade could be wildly volatile within the next few weeks. Look for the China currency fix to come in hot. Okay, and I've mentioned this again a little bit last week, but now it's going to be used. They're going to weaponize their currency in the very near term. And when I say the Chinese currency fix, listen, this is not something, do you need to stay up late worrying about this? No, but you do have to recognize that if there's going to be a large currency shift, okay, in China, it's going to happen in the after hours. So effectively, it's going to rock S&P futures before the cash open ever even occurs. It's why I put it on here, because I think a lot of people are just kind of like, oh, right, I'll just wait for the marketplace, and if it's going to sell off. No. The way that the currency fix would actually work is the currency fix would come in really, really hot, and it usually comes out late afternoon Pacific time. And again, this could be coming as soon as like Sunday afternoon, right? So the currency fix comes in, and it could absolutely rock S&P futures and the overnight trade, which of course rocks the entire marketplace. All right, let's move onward and upward for the currency fix. Heavy selling hits again, but risk, it ain't feeling the fear. So, one of the things, I looked a lot at the S&P 500 over here. We looked a little bit at the SPX, okay? But there's some things that really stand out, all right? And one of the things that, again, I'm not a big proponent, if you will, of looking at the VIX, okay? But net, I think the VIX it's a great way to get, all right, to you, the point of, listen, we're not even at a 20 VIX, right? You're like, what does that mean? Okay, we're not even at a 20 VIX. You just saw a 70-point S&P move, which amounted to almost 2.5%. The NASDAQ got smoked by the tune of almost 3%. Okay, and the VIX, it's shrugging its shoulders. Okay, the marketplace, once again, it isn't really feeling the fear. Why should you be concerned at this point? Well, here's the issue, okay? What is at issue is recently the market came down hard and fast. The volatility spiked, right? And then it rallied back up, and then it came down and rallied back up, and it came down, right? Listen, the market's already seen this movie a couple of times before. It just simply does not care. The point being over here is when you start looking at the VIX, okay? Yeah, it was a decent spike up. But again, the market, it's already seen this risk. It knows what it feels at 28.40. See, when you see the same vicious move, okay, happen multiple times, it's not as vicious. You're like, oh, cool, man. The S&Ps are down 70. Well, if you hadn't seen a 70-point move, what? Last week was a 90-plus point move in the S&Ps. If you hadn't seen it the week before that, you'd think to yourself, holy crap, a 70-point move. You know what the VIX is saying right now? Yeah, that's a 70-point move. That's nice. Okay. It's way too mellow out there. It's quiet. It's dangerous when it's quiet. You better remember that. It's dangerous when it's quiet. The VVIX is saying something very different, though, and that's exactly what I wanted to show you. The VVIX, okay, the volatility of the volatility index, says, holy crap, duck and cover, get under your desk and start rocking back and forth. Because what's interesting about this, the VVIX is hedgers, right? And it's actually towards the very top end of this range. Why? Okay, I have to ask the question, a very simple question. The VVIX, which is the volatility index, effectively what it's saying is, hey, are traders going out there and buying monstrous amounts of calls? Why do they buy monstrous amounts of calls? To hedge. Well, I have to ask the question, why are they going out and buying? They're buying volatility, okay? It started at 100 on Friday morning. They bought volatility at a 100% implied volatility. Think about that for a second. Why would you pay that much, okay, for what? Covering your butt for a couple of days. It's outrageous. I'll tell you why. Because there really is fear. It's here. It's not in the VIX. The VIX has seen the movie before. Okay, the VIX has seen the movie before, but the VVIX tells a very different story. The VVIX is actually telling you, no, this is real, man. This is going to hurt. This is going to hurt. And then you look at the volatility futures. Now, the volatility futures, they look just like the VIX. Read deeper. The volatility futures, okay, we've actually inverted again. So we got ourselves some backwardation. What is backwardation? Well, the short-term 25-day vol futures are now once again exceeding 53-day vol futures. What does that effectively mean? What have we won? Oh, nothing but more risk. I mean, this just makes the market, the way to think of like the vol futures, like flipped over like this, or, you know, in backwardation, okay, instability. It's just instability. It takes off the plate, if you will, any like quiet days. There's no quiet days in a marketplace that have the volatility futures and backwardation. So if you're expecting it's going to kind of mellow out maybe this week, sure, it could, but it's going to start off with a bang. You better believe it, because those vol futures flipped over, make it Mr. Toe's wild ride every single time. So again, heavy selling hits, but the risk, it's not really feeling the fear, at least not the VIX. But you're looking at other volatility indications that are saying, yeah, this thing's getting ugly. Okay. All right. The next thing I actually want to bring up, we best start evaluating our net positions. Ugly this time might be unthinkable. Here, again, a little bit of an opinion piece mixed with some risk management. Listen, all I am suggesting is this. You know, if you're on Thinkorswim, hey, wonderfully. If you're not, like, I get it. You know, there's a lot of different trading applications out there. I like to pull up the spiders, and I'm actually going to close up this left side bar, okay? And all that I'm propositioning in this particular case is that you best know where you stand in the world. I come over here, go from show all, I'm going to hide all simulations, and I'm going to come over here to portfolio beta weighted. Now, this is an account that I use exclusively for TheoTrade, but here, in our TheoTrade account, net, and by the way, these are all live positions. Here is where I stand. I'm negative 1,500 spider deltas. I'm beta weighted. Okay, and you're like, what is this thing? It's my risk array. Okay, what my risk array says is how much money I can make if we go up 2%, down 2%, up 4%, down 4%. Hey, listen, in a time like this, when you know that the vol futures are in backwardation, when you know the VVIX is lighting it up, right? When you know that, you know, bonds are in never land over here. I'm not telling you anything you don't see on your screen right now, okay? You better know what your risk parameters are, both to the upside and the downside. There is no bias in here. I don't care, okay? But you better like recognize at this point in time, you're in this really tightly wound volatility box. Ugly, you might not be able to even dream of what ugly is about. Okay, you know, one thing that I take the spiders, I pull up this like 9-month chart. Forget that crap. Forget it. Pull up like a 10-year. Oh yeah, that's nice. Oh, let's just pull up like the maximum chart available. Oh yeah, no, that's healthy. It's healthy. I'm being a little bit sarcastic with this. If you don't know what your risk is moving forward, it's on you. I'm telling you, you better know every single dollar that you can make or lose moving forward, and you can even push the date forward, play around with it. Because, listen, we are on possibly the verge of things getting very, very serious in a hurry. And I don't say that to fire a warning shot across the bow, okay? I'm negative 1,500 deltas, and I'm telling you, you have a day where the S&Ps can easily move 100. Easily, these S&Ps can move 100. You're talking about north of 3% moves. Why not? We haven't seen one too often. That is very likely occurrence in some of the trading sessions to come. Think about 3% moves. In fact, when you go to your Analyze tab, you see where it says up 2%, down 2%. Yeah, you can change that. You can actually come over here and set slices and go 11 rows of 3%. How's that grab you? If we go up 3%, I'm going to lose 11 grand. But if we go down 3%, I'm going to make 14,000. I don't know about you, but I kind of like that risk reward. I mean, these are positions that I have on right now. It's not every account, but they're positions that I have on right now. And I got to tell you, get a handle on your risk right here, right now, or it's going to have a handle on you. So you will not be able to function if you can't control some of the risks that you currently have on. And I want you to be thinking of that moving forward. So ugly, again, might be unthinkable. All right, volatility readings, all this action, and a 19 VIX. I wanted to reiterate this one because it just really, really resonates with me that the VIX itself is sitting at the just shy of the 20 handle after what? Everything that we've seen. Market's taken everything in stride. And that actually relates to correlation coefficients. Now, the reason that, in a session like this where I'm coming in here and I'm giving you a market update, these are the things that I look at. I look at like volatility. I'm looking at the S&Ps. I'm looking at again, what the bond market is doing. I'm thinking about hey, the Fed fund futures said there's a 95% chance of a Fed cut, but Jerome Powell didn't say that. Why am I not talking more about individual stocks? Because the correlation coefficients, there's just no escape. And you're like, what does that even mean? Okay. If you look at like a heat map over here, this is a heat map, right? You can see it's red. I don't look at that. I look at the index watch, come down over here to a public list, go to the S&P 100. There is no escape. Okay. It doesn't in times of volatility, this is when people go, yeah, but it might be safer for me to maybe buy what? Where are you going to go? I want to hear it because the entire S&P 100, okay, moves in almost a perfect correlation coefficient. There's just no escape. I mean, you want to get crazy in here? Look at stuff like XLU. Here's the utilities, right? XLU in the utilities right now. Even the utilities got whacked by the tune of 1%. Okay, which almost doesn't even make much sense because the utilities, by the way, the utilities that do carry a position in here, okay, the utilities have been impervious to anything. But here's actually, again, correlation coefficients. They get them, one of them, they're going to get them all. Keep that in mind. There's no easy escape in a marketplace like this. Sure, there's going to be things to offset risk. Sure, volatility goes up when the market goes down. Sure, the bonds typically go up, okay? But net, individual stocks don't matter that much, right? They just don't matter that much. By the way, to show you a little bit about how wild correlation coefficients happen to be, I'm gonna show you something that is absolutely unequivocally in my mind awe-inspiring, okay, of how efficient the markets are. This is an expected move in the SPX. It's the options market depiction of risk. Okay, last week. Now, last week, we're supposed to have a $58 move, right? So let me actually script this up here. That's a $58 move up or a $58 move down. Now, the S&Ps came screaming down on Friday. They just came short of the edge of the expected move, and they stopped, and they actually reverted back up a little bit. You're like, okay, Don, I see that move. Great. And we'll talk about the expected move moving forward in a second. But did you think to look at the expected move on something like the financials? What do the financials look like? Okay, here we have auto expected moves. The financials did the exact same thing. The correlation coefficient is uncanny. Look at that. The financials did the exact same thing. You're like, oh, okay, that's cool. I get it. What about Apple? Apple got absolutely smoked on Friday. Look at the correlation. Oh, look, it actually almost touched the bottom of it and bounced right back up. Wait. What if we pull up something like, I don't know, Amazon? Okay, it's Amazon. Look, touch the edge of the expected move. Okay, it doesn't matter where. I mean, you can pull up anything you want. You want to pull up like Tesla? You're like, Tesla, that's not in a good correlation. Really? Because it looks exactly like it. All right? Where else do you want to go? You think about this for a second. When I talk about correlation coefficients, that's one of the most heavily studied areas, okay, in markets. There is no escape right now. That's why I'm not talking about individual stocks, because quite frankly, it doesn't make a difference. You get your positions on, you better be comfortable with your overall risk, because if we're going to start to rock, there's no escape. Now, in those expected moves, you should know that the S&Ps, okay, specifically the SPX, let's get ready to rumble, because the SPX has, all right, a $70 expected move, a $70 expected move in the coming week. Now, hey, listen, that's a $70 move higher, a $70 move lower. The previous week was $58. The previous week before that was also $58. Volatility has expanded. Timeout. I called timeout over here. Okay. Wait a second. You're telling me the expected move for the entire week is $70. Yet we moved $75 on just Friday alone. Timeout. That's not a very high expected move, is it? Given the fact that in one day we can move 75 points, but in an entire week they're only pricing us to move 70? Okay, time in. Do you get exactly what I'm saying? Don't you dare get caught looking. Meaning that you don't really want to be a premium seller in a week where, yeah, we're supposed to move $70 all week. We move $75 in a day. That ain't going to be me. That's not going to be me selling premium in there. No how, no way. I don't care if the volatility's up to 22%. But still my heart, it's nothing. It's a nothing burger. Okay? We're seeing wild moves right now. Step back, get long gamma. Don't get caught short gamma because you're going to get your head taken off. Last, but definitely not least, somebody has a case of the Mondays. What does that mean? Look out this Monday. Okay? You know, this is where I've been trading a lot of years. And it's bad Friday. I get it. Some tweets are flying, of course, in the aftermarket hours of Friday, but we could expect probably some more action because of the G7. What? China wasn't invited? No, China's not part of the G7. But if they were, do you think they would have to wear like a shirt with like the scarlet letter CM, currency manipulator? I knew it. Anyway, I would expect a whole lot more risk getting thrown at you. This one, again, is more, I guess trader spidey sense, if you will. This coming Monday, it could get wild out there. You got a $42 expected move. There's weeks that go by you don't see a $42 expected move. Monday, this market's going to be rocking. Again, you could get actually the currency fix from China coming out on Sunday night that could rock the markets. Nevertheless, it's going to be a long trading session on Monday. Get ready for it. And I'm going to tell you, this weekend, if you haven't spent some time getting real intimate with your risk, you're going to put yourself in a very precarious position coming into Monday. Again, I'll reiterate, I'm not selling premium right now. Okay, I am a net buyer of some options premium even in the heavier volatility. That's kind of number one. Number two, you better know your risk because, number three, the correlation coefficients are sky high right now. Okay, people, markets, they're on the verge of getting ugly. You got to be aware of what your risk is, okay? You can't perform well unless you can handle what you already have on. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.